Urgent, liquidity crisis, 3 asymmetric moves to protect your savings. Lock in, a systemic liquidity squeeze is unfolding now. Key indicators, liquidity coverage ratios hitting critical thresholds, overnight lending rates spiking 340 basis points recently, and the Fed's reverse repo facility falling below $200 billion, show funding is evaporating. When liquidity dries up, banks become illiquid even if technically solvent, deposits can become trapped, withdrawals restricted, or unsecured funds converted in bail-ins. How the crisis works: fractional reserve banking depends on confidence. If many depositors withdraw, banks must sell long-duration assets at losses to raise cash, which can wipe capital and trigger runs. Historical parallels include 1933 and later bank panics. Today, banks hold large unrealized losses on securities portfolios. Forced sales during withdrawals would realize those losses and accelerate failure. Why this episode is different: rapid, large treasury issuance and quantitative tightening have drained systemic liquidity. Secured funding stress and commercial real estate maturities through 2026-27 threaten regional banks holding CRE loans. The combination of tight funding, rising rates, and maturing CRE debt creates a brittle system where confidence shocks can cascade quickly. 3 asymmetric moves to protect and profit. Convert counterparty risk to final settlement. Hold physical precious metals, gold/silver, in direct possession or fully allocated. Segregated storage you control. Physical eliminates bank counterparty freeze risk. Target allocation, at least 15 to 20% of liquid net worth based on risk tolerance. Buy high-quality mining equities and royalty firms with low geopolitical risk and strong balance sheets. Mining stocks offer leveraged upside to rising metal prices. Prioritize producers with proven cash flows and long mine lives. Prepare liquidity for distressed credit and real asset purchases. Maintain cash or short-term treasuries to buy quality assets at distressed prices when banks are forced to sell. Immediate practical steps. Move uninsured deposits, over $250,000 per bank, to multiple banks, treasury bills in a brokerage, or other safe vehicles to avoid concentration risk. Contact custodians now to convert unallocated metal to allocated storage or request physical delivery. Document any refusals or delays. Shorten bond durations and favor cash-generating, inflation-protected assets. Build a liquidity reserve, short treasuries or T-bills, for opportunistic deployment. Monitoring signals, watch the reverse repo balance, secured overnight financing rates, bank deposit flows, unrealized securities losses, and CRE loan maturities. These are leading indicators of accelerating systemic stress. This is time-sensitive. Act now to reduce counterparty exposure, secure physical holdings if desired, and prepare liquidity to buy distressed quality assets.